the Fed increased rates again. And what does that mean for you? It's actually some good news I'm about to tell you. Get the noise out. Join me for Investment Minded. This is Nick Despotidis here in Washington, D.C., talking about the Fed. March 2023, huge news came out. And what did the Fed just release at the end of March? That they were staying consistent. They were not stopping. They are increasing the Fed funds rate. But wait, Nick, aren't you upset about that? Well, not really. They committed to this. They're doing what they're saying. So it actually had a positive movement on mortgage rates. So a lot of people don't know, as a real estate professional and knowing a lot of loan officers, this is good news for the consumer. The banks are finally realizing, or the Fed is finally realizing, that they can't increase rates anymore. So they have committed to a quarter point percentage, which they did, and they're predicting in April, they've committed to another 0.25%. After that, they are not confident that they are going to continue raising rates in 2023. When I say rates, this is the Fed fund rate, which is different than mortgage rates. Mortgage rates has to do with confidence. The mortgage industry is confident that rates will no longer go up, so they are no longer pricing that to the consumers because they are the end users of the Fed funds rate. The Fed funds rate is what banks use to trade in between each other. That's what they charge each other. They pass that risk on to the consumer when they know it's more risky. Now it's less risky because they know that the Fed is going to start decreasing rates. By the end of the year, research shows that rates will be in the low 5s, and next year it's going to be in the high 4s. So right now, rates have gone up and down, mortgage rates that is, shifting over to mortgage rates, have been going up and down in March because of the uncertainty and the volatility and the risk. And they've been pricing that in. So it's gone all the way up to 6.5% with Fannie Mae, which is the baseline. And they've gone down today to 5.6% Fannie Mae is charging for a 10-day lock. 5.6% today. Last week, you were up to 6.5%. So this is good news because we know there is end in sight. The investment-minded people like you understand that this is not going to last forever. Just like in 2007, 2008, and 2000, 2001, when the Fed funds rate went all the way up to 5% and even 6%, recessions followed. And what do we know in real estate about recessions? It is very good for real estate because that's when money becomes a lot cheaper and we're able to buy and sell houses and move around. So I'm not an economist, but I did work for the FDIC and I did work for Citibank, and I've talked to a lot of mortgage officers. The Fed funds rate going up is not the issue. It is the risk associated with the banking industry that is the issue. And now that they have priced that into it, the Fed and FDIC have come in and taking over these banks that are not one-offs, two-offs, but they're idiosyncratic events in the marketplace that were heavily leveraged with unsecured deposits. So when the Fed met, Jerome Powell said, these are not every bank's problem. Yes, it is something that we're monitoring. We've been risk planning since Dodd-Frank was enacted in 2008, 2009. So what this means for you, lower rates in 2023, this is great news. Think about it as the mortgage rates, not the Fed funds rates. These mortgage rates are going down and it's better for the consumer. And we're identifying these risky banks like Silvergate, Signature Bank, and Signature Valley Bank, and they're being taken over, liquidated, and picked apart by bigger banks that are able to hold them. Unfortunately, smaller banks, so make sure we support those smaller banks. Like I said, they still have great programs and they're able to hold deposits. And now they're even talking about insuring more than $250,000 because that was an old rule, right? $250,000 doesn't mean as much as it did 20 years ago. So great news out of bad news. We got the bad banks out. Now we are definitely stabilized. We're in a forward-looking mentality, and the mortgage industry is a lot more confident. to give the consumers a better rate and stop pricing that risk in. All right, talk to you next time. Let's keep on this. Let's keep talking about programs to get you into a house. Let's keep talking about the market because it is ever changing. Talk to you next time. Make sure you like and subscribe.